Have you ever noticed that the way people think about investing often changes once their portfolio crosses a certain size? My name is Jack, and I have spent over 10 years helping people navigate financial decisions. And one threshold that repeatedly changes behavior is the moment an investment portfolio approaches $200,000. At first glance, the number itself does not appear dramatic, and for many investors, it arrives gradually after years of consistent saving, steady employment, and patient contributions. Yet somewhere near this level, a quiet structural shift begins to occur in how money behaves inside the system, and more importantly, in how the investor perceives that system. During the early stages of investing, progress is driven almost entirely by contributions. Each month, deposits flow into the portfolio, and the balance slowly climbs upward. Market movement still matters, but the investor's own income and saving discipline remain the dominant force pushing the portfolio forward. When a portfolio is small, the system is powered mostly by effort. However, as capital accumulates, the balance itself begins to generate larger movements. Once a portfolio approaches $200,000, even modest percentage changes in the market can create swings that rival what an investor contributes through savings. A normal market fluctuation of 6 to 8%, for example, can move a $200,000 portfolio by $12 to $16,000 over a year. At that point, something subtle begins to shift. The investor realizes that the portfolio is no longer just a container for savings, but a system that now responds significantly to the broader market environment. Contributions still matter, yet they no longer dominate the entire trajectory of the account. Behavioral economists often describe this moment as a psychological transition from accumulation thinking to capital management thinking. Earlier in the journey, the primary question is simply how much can be saved each month. After capital reaches a certain scale, attention gradually moves toward how the portfolio is structured, how risk is distributed, and how volatility influences long-term outcomes. This shift does not mean investors suddenly change everything they do. In many cases, the underlying investments remain similar, especially for those who follow diversified strategies. What changes is the perspective from which decisions are made. Investors begin paying closer attention to allocation, rebalancing, and time horizon because the portfolio's internal dynamics have become more visible. History shows similar transitions whenever financial systems cross meaningful size thresholds. Small pools of capital respond primarily to input, while larger pools begin reacting more strongly to external forces, such as market cycles, interest rates, and economic shifts. The same principle that shapes large institutions quietly begins to influence individual portfolios as well. Understanding this threshold is not about treating $200,000 as a magical number. The exact level can vary depending on income, saving rates, and investment strategy. What matters is recognizing the moment when the market itself starts moving a portfolio nearly as much as the investor's own contributions. When that realization appears, many investors naturally adopt a longer perspective. Instead of focusing only on the next deposit or the next price change, they begin thinking about how the entire system will behave across decades rather than months. In that sense, the $200,000 mark often represents less of a financial milestone and more of a mental transition. It marks the moment when investing gradually shifts from an act of saving money to the ongoing responsibility of managing capital within a much larger economic system.